Hi, I'm Mark Gehlbach. I'm one of the co-founders of True North Advisors, and I'm sitting with Chris Pate, who is our COO, sits on the investment committee and is a key part of our portfolios, both on the public side and the private side. And we're a few days away from the end of the first quarter, Chris, or 60 days to be exact after the inauguration. And what a 60 days it's been. Can you give me some thoughts on what's going on in the markets?
It's kind of funny that everyone is wringing hands, and there seems to be a lot of consternation over what's going on, and everyone's trying to figure it out. And then I look on my phone this morning on the way here, and the S&P is only down 4% for the year. So it seems like a lot of conversations. The intra month volatility has been somewhat high, but on a little bit of a longer term view over 6 months or a year or 2 years, et cetera, markets are all generally still way up. So it's interesting to me that there's so much conversation about this volatility, and maybe it's just because we haven't had any in a while.
Well, I was going to say, is that a function of back-to-back 20% returns in the S&P? Is it the assessment that maybe this is how stocks work?
I think some of that. I think the election also, just as you mentioned, being right here. Market clearly being a little bit surprised by how aggressive Trump has been on negotiations and other things, and I had a client meeting earlier this week and mentioned that Trump did have a book that came out in 1987 called The Art of the Deal, and he is a deal person and he likes to negotiate, and so it is very much to his advantage when negotiating, whether it be with Canada or, you name it, for the other side to think that he's absolutely crazy and will do, potentially anything. And so, like, the market loves certainty, and this is not bringing certainty to the markets. And so it makes sense, philosophically, that we're going to see some volatility during this time, because we really don't know, what is going to be said, from the executive branch on a daily, weekly, monthly basis. So,
well, how do you feel about the uncertainty paired with just asset valuation? And really, maybe you can talk a little bit about the last 20 years and the accommodative monetary and fiscal policy, and maybe the state that we're in today. So uncertainty, high valuation, and pretty much all asset classes.
Right. Well, and I think that's right. So valuations are generally high. We're talking public and private markets. The biggest change that has occurred, let's just say since the beginning of the last presidential administration, 4 years ago, interest rates were at zero. They had been at zero for a long time. And I think we'll look back at that, call it, 2010 to 2022 time period as being pretty unique in history. And we're obviously not in that situation now. So from a markets perspective, we had an investment event a couple of years ago, and I remember one of our credit managers saying that what was going to occur in the next few years is there is going to be a very large wealth transfer from the equity owners to the lenders of any business. And you can think about that as, public companies that have debt, or private equity companies, which generally all are fairly levered, real estate owners, et cetera, and infrastructure. So rates go up dramatically in 22 and 23, and 24 was the first real full year we had of digesting what are larger, higher absolute rates. And so for all of these businesses that have debt on the balance sheet, it can be a material difference. And it's been a bit surprising to me, and I think maybe our investment team, that valuations have stayed where they are, knowing where the debt markets are and where rates are. I think it feels to me more balanced. Rates shouldn't be at zero philosophically. So I think the market seems healthier, but there are a lot of situations where businesses or certain assets were over levered, coming into 2022 that are really going to struggle. And so I think we might be in for a very interesting next, call it 2 or 3 years when it comes to distressed assets and other things that we haven't really talked about for a while.
I'm gonna take a step back and talk about our investment philosophy and our approach to trying to value an asset, and knowing that over a market cycle, the market should recognize that valuation. But there are sometimes these exogenous events that benefit the investment thesis of valuation.
I think there are a lot of asset classes that you tend to see market cycles regularly for a long period of time, and you can't necessarily predict the timing of when something is going to occur, but that there is going to be a shoe to drop, in that particular asset. And distressed credit would be a good example of that. High yield bonds, you can look at the spread of high yield bonds versus treasuries. It's a very well tracked indicator for effectively, giving someone information about the health of the credit markets and what borrowing looks like. And historically, about 600 basis points over treasuries is where high yield bonds would be. And in the last, since COVID, there was a blip during COVID where they widened out dramatically. But since, call it, summer of 2020, high yield bond spreads have been very tight and are currently in the mid 300 basis point neighborhood. That's widened out. I think last time I looked, it was 75 basis points from the tights. But credit spreads are still very tight. So when spreads are very tight, you don't necessarily want to be lending. When spreads are wide, when things feel dangerous at the time and the hand wringing is occurring, that's when you want to be, lending that money or buying, bonds at 80 cents on the dollar, for instance, et cetera. But then the flip side of that too is knowing when to avoid certain asset classes that you're looking at the other side of the coin.
Yeah. It strikes me that oftentimes our investment team gets excited in periods of volatility and stress. And that's almost counterintuitive for a client's perspective, right? I mean, usually clients will tighten the hatches. They'll get nervous to extend some risk. I mean, I feel like our investment team almost is counter to that. In other words, we're more cautious as the markets are, ripping up 20% year over year, and then get really much more aggressive and interested in opportunities when markets correct or even go beyond a 10% decline. Can you talk a little bit about that?
Well, I think that's in the DNA of some of us. I mean, I spent 11 years at a hedge fund in Fort Worth, Q Investments, that largely made money distressed investing. And so I always feel a little badly about what you just said. It's like rooting for the hurricane or the tornado. At the same time, it is, I think, genuinely exciting from an investment team standpoint to think about an opportunity set changing. And that happened really quickly during COVID, but it really there hasn't been anything since then that's happened that's been very dramatic. But I do believe that it presents a great opportunity for the investment team. It's our job not to think about things through the lens of emotions and what does this mean, to me personally? Because obviously all of the money that all of our clients have, there's a direct impact on what happens with their lives. But our job is to think through the standpoint of risk reward and what we're able to do for them. One interesting thing about what we're seeing in the market today, it's actually really challenging from the investment team's standpoint, is a much higher percentage of the opportunities that are flowing through to us at the moment are what I would call attractive versus, let's say, 2021 or 2022. And I'll give an easy example. Real estate, there were a lot of real estate deals that occurred in 21 and 22. It was very easy to raise money. Interest rates were at zero. a bunch of real estate groups that were syndicating deals were buying assets with very low yields, and it was pretty easy for us to say no quickly to 8 out of 10 deals, that we saw in real estate private equity, let's say during those 2 years, that time frame. Fast forward to the end of 24 or early 25, and I think that's about flipped. I think about 8 out of 10 deals that we see look kind of interesting, and there are rescue financings that are occurring, based on deals that happened in 2022 that probably shouldn't have happened at that price, and someone's maybe putting in preferred equity to to fix a capital structure, that kind of thing. And so that goes back to your question. It's very interesting when there are maybe storm clouds on the horizon in terms of the credit markets or whichever asset class you want to talk about. At the same time, it's a challenge for the team because it's much higher percentage of the deals look interesting, and then we've only got a finite number of people, and what can what work can you do? And so sorting the wheat from the chaff quickly is part of what's going to ultimately make us successful. And the seeds that we plant today or in 2025, we'll know in 2, 3, 4 years in the private markets how that goes. And the same thing goes for the public markets, although they move more quickly. And as we've said, the public markets haven't moved very dramatically yet.
It's interesting. We're talking a lot on the private side, and it strikes me that the advantage of the vintage year series approach and getting time diversification and having fresh capital as you enter into a business cycle. There's new opportunities. To your point, the real estate deals that you're looking at now are much more attractive. Talk a little bit about the diversifier bucket, because I find it interesting. It's meant to be low correlation to traditional long-only stocks and bonds, a good return over a market cycle, but to act differently. We certainly saw that in 2022. Maybe you can talk a little bit about that specific environment. Obviously, high inflation, Fed raising rates faster, more times than in history. But we're starting to see it again in the last 60 days. Literally, it just flipped relative to long-only large-cap domestic stocks.
Right. Well, and you have these interesting little asset classes like metals and mining, for instance, that tend to get left for dead in times where the market is really exuberant and no one's thinking about hard assets like that. And then all of a sudden, what's happened in the first quarter so far of this year is we turn around and gold is sitting at 3,000, and a lot of the mining companies are up 30%, for the year. And so having a number of unique, somewhat uncorrelated assets within a vehicle can be very fruitful in times where there is big market volatility. And Ray Dalio talked a lot about this in Principles and his book. But effectively finding 7 to 9 uncorrelated return streams and putting them together, that you end up with a portfolio that is a lot stronger than you otherwise would. And so you need enough things that look different from each other. But each of them has to have underlying characteristics that make the investment team confident that this is going to work, over a long period of time, independent of what's going on in the stock market next week, next month, next quarter. But the diversifiers book seems to get forgotten a little bit when the markets go up, and then really outperform when things go down, and that's kind of the point.
Yeah, that's great. Well, Chris, thank you on behalf of our clients and the firm for the work that you and the rest of the investment team are doing in terms of stewarding our clients' portfolios.
Absolutely.
Yeah.
Excited to do it.
Yep.